660 credit score. That's the national average score for people in the United States. Do you have a credit score that's higher than 660? Comment yes. Do you have a credit score that's lower than 660? Comment no. I'm Ben Dodd. I'm a credit expert, and I'm here to tell you what a good credit score is, and if you don't have one, how it can affect you. Before we get started, I want you to subscribe to this channel now. The reason why is I don't want you to miss notifications the next time my credit videos come out. So who is actually using your credit score? Well, actually, over 90% of lending decisions in the United States are made and based on your credit score. So that's pretty much anybody you're applying for financing with. That could be mortgages, autos, credit cards, student loans. Any of those companies or entities that you're applying with for some sort of financing is going to utilize a credit scoring system. The key here is to realize that there's a different FICO scoring model for each of those individual things. An auto score won't match a mortgage score, and so on. There's also, you need to know that there's other scoring models. They're going to utilize your credit and scoring for things like rental. They're going to check your credit for utilities. So if you're setting up utilities in a new place, they're going to check your credit and the credit score. And what your score is could determine if you have to put down things like a deposit. Then there's stuff like there's even employment now that they've got a scoring model for. So, it's very important that you have good credit and a good credit score. And those are the people who are going to utilize that. So what is your credit score range? Well, we all know that the higher the score, the better. And I already told you that the national average is 660. Well, that's considered fair. Actually, to participate or to get the best buying power, the lowest interest rates when applying for financing, you need to be at a 760 or higher. So some of these ranges, and we're showing you the score ranges here, some of those ranges can affect the ability to even obtain financing, and it'll certainly directly affect the amount that you're going to pay for the financing that you're getting. So your score range is extremely important. Okay, so you know the score. We know that there's these different score tiers, but what does it mean, and how does that affect you? Well, it directly affects, again, your ability to even get lending or financing or be told yes or no for things like rentals, but it's going to directly affect those things. Usually the higher tier is that upper tier above 760. That means that you are going to be giving the highest loan amounts or the available credit. You will get the best interest rates. There'll be very little to no fees, and the loan process is going to go through a lot easier and quicker for you because you've shown a great track record of repaying your debts and just it being very little to no risk at all. So they're not going to look at more, requirements or stipulations for things that you have to prove to them that, hey, I'm still worthy even though my score is there. Once you get down in those lower things, you're still going to be credit worthy. 680, that's 680 range, or 720 to 680, even down to even the 650s. You're still going to be told yes, but there's going to be some restrictions on the loan amounts. There's going to be balance to limit ratios and things that are going to affect the amount that you're going to get, and if you're going to be told yes or no, it's also directly going to affect your interest rate. It really affects things like mortgages and auto interest rates by significant amounts that are very costly. So and then anything below that is going to affect your ability to get financing, or it's going to put you into some sort of subprime category. Subprime is going to put you in those higher risk credit cards, which are going to have higher interest rates, and really it's going to kind of keep you in that area, and it's not where you're going to want to be. You're going to pay more for autos, not be able to get the car maybe you want or you deserve, maybe not even get a mortgage. So you drop down below that, that's where they start telling you no. So those are your credit factors and how they affect you. So if you applied for credit, now you've already heard about what a FICO score is. You've learned what that is because, like I said, over 90% of lending decisions are based on a FICO credit scoring model. But FICO is a brand of credit score. And what is a scoring model? Scoring model is simply a model or an algorithm. It's a computer computer thing that computes your data that's given to them by the credit reporting agencies. And what that does is there's different models based on what you're going to buy or what kind of service you're going to obtain. So, like a mortgage, for instance, is going to take in a very large amount of data because it's such an expensive purchase. They really are going to scrutinize your history for a long period of time. So that scoring model takes in a lot of data and it looks heavily at the most recent or 2 years of payment history. So that scoring model is going to be usually affected more by lates or any major derogatories, especially in the last 24 months. And if you have prior mortgage history, it's really heavily weighted on that, and it can be affected by rental information. So that's a difference in that scoring model. So there's really a different scoring model for everything you purchase. So again, autos and credit cards and things like that, and they look at different factors. And I know it's confusing, and most consumers really check their credit and check their score kind of backwards. They usually apply for something and then usually find out what their score or scoring model is, or if they've even credit qualified. It's also a bad way for them to find out that, hey, there's something on my credit that I didn't even know about. So these scoring models are going to, all they're doing is they're kind of weeding out the risk factor for you or for any other consumer who applies. Are you good to lend to? Do I have a good history? And those scoring models focus on that directly. And again, like I said, over 90% of lending decisions are based on those scoring models that they subscribe to and purchase for you. Be wary of the scoring models that you're getting on free sites, Credit Karma, any of these other credit monitoring sites, the free ones on your credit cards. Generally, they claim they're either a FICO score or they just say they're a scoring model. Read the fine print. The consumer scoring models that you're getting generally are Vantage scores. They just don't take in the same amount of data or the right data or the data that they're going to need to match a FICO score. So we hear a lot of complaints about people saying this Credit Karma score or my Discover credit card score didn't come anywhere close to what that FICO score was when I went to apply for a mortgage. That's common. Again, it's not the scoring model. To get access to those, unfortunately, you generally go to the mortgage professional to have the stuff pulled, or go to an auto dealer. But the key is if you have good payment history and good stuff on your credit, you're going to have a higher credit score. But know what your credit is before you go to make large purchases, and figure out which scoring model is going to affect what you're going to purchase. And a pro can help you with that. Okay, so we talked about the credit scoring models and that they compute the score. But what data or what is actually given by the credit reporting agencies on your credit report to that FICO scoring model to determine, to let it spit out that score for you? And really, it comes down to certain categories of your credit and the data that's sent to them. So one of the biggest percentages of that categories are things like payment history. So your payment history is obviously your most important, and it seems common sense, pay your bills on time. But having one late pay or you forgot a payment or something like that can drastically affect your credit and your credit score. It'll definitely drop it significantly if one of those shows up, because it does equate for 35% of your credit score. The other one's credit utilization. So what's that? I mean, credit utilization is how much credit do you have available, or how much credit are you using? And this is where you see a lot of people giving advice like, keep your credit card balances lower than 30% to really get some scores up there and get your score increases. And really, the lower the percentage, believe it or not, the more your credit will increase. But available credit is also a big portion of that. So if you don't have credit cards or you don't have revolving credit, you need it, because it needs that data to score, because it is such a large portion of your credit report. Just installment loans like mortgage and autos are not going to be enough to really get you to that upper echelon credit. You really need to show some responsibility and show that you have available credit, because that's the best thing that can factor or raise credit scores in a period of time. Credit history length is the other thing, and that's something you can't make. That's that credit card you got maybe back in college or school, and you still have it open. So having your credit open is good, as long as it's a good positive reporting item. Credit history is also affected by getting new credit. So applying for new credit and getting You don't want to apply for credit unless you really need it, because new credit isn't considered established credit, and that new credit can drop your scores initially until you show some responsibility and the ability to pay that in a timely manner. So a card, for it to be established or considered, good credit history, is going to be a minimum of 12 months. So whenever you get a new credit account, that it's going to take 12 months for that to really consider it an established account. Your credit mix is important. Like I said, you need some revolving credit on there, but you want to have an installment loans if possible. Mortgage is excellent credit history. So that mix of credit is going to be important, because there's three factors in the scoring there. It wants to see mortgages, installments, and revolving credit, and see responsibility with paying those in a timely manner and using them the right way over a period of time. So a good credit mix really helps. And then new credit accounts, that just comes into play. Look, if you just have the same accounts over and over, but you don't really have any new accounts, or you're lacking in that credit card account, it might be a good time, or you might need that data to get it. The average person with like the exceptional credit range of 800 plus usually has anywhere from 6 to 10 trade lines reporting on their credit report, and those can be open or closed. Some of those closed accounts, they're still going to report for that 7-year period of time, so that's still being accounted for in your scoring model. But that new credit accounts, having some newer credit is going to definitely help if you need for that available credit and helping your scores. So that's about 10% of the mix. And here's here's a chart of all those breakdowns there. But those are what categories are the data that's being sent to determine what that scoring model is gonna compute your score at. A credit and your credit score is completely different for everyone. I've never seen in all of my years the same credit or credit score for anyone. I've had people that have been married for 20 years that have had the same. They have the same mortgage, joint account. They've got autos, joint account, joint credit cards, but still their scores are different. And it's simply because the data is never exactly the same. So every credit score is going to be different, and it's going to be different across the three credit reporting agencies as well. They just take in different data. So every credit report and every credit. So the bottom line, your credit score is very important. I actually came up with a new saying. It says you don't have to live, die, and pay taxes. It's live, die, pay taxes, and have a good credit score. Because the credit score is used for so much in this day for just everything you're going to buy, and that credit score is the factor that's going to determine how much you're going to pay for everything. And so having that 660 average credit score like everybody else in the nation, you're considered fair, and it's just not good enough. You got to get your scores up, or else you're going to pay more throughout the rest of your life for everything. Or worse, you could be told just no, you won't get credit, or I won't get the credit that I need. So credit score, credit factors, the scoring models, you don't have to check them every day. You don't have to know what it is every day, but at least once a quarter, you got to know where you stand. You got to identify. It's the only way to be vigilant and know if something's shown up on your credit that shouldn't have been there before. So know your credit score, know your factor. Find some good credit monitoring. We've got a link that is a decent credit monitoring company that we use. That's not. It's very objective. It's not related to any of the credit reporting agencies. Be wary of the free ones. Nothing's free in this world. So those Credit Karmas and stuff like that, you're gonna get your data out there, your personal information. They're gonna share it with their affiliates, and those affiliates are generally credit card companies, and you're gonna get a lot of credit card offers that's gonna come along with using that free service. So, just be vigilant. Check your credit score. If something's bad, do something about it.